This meeting is being recorded.
Welcome everyone to our webinar. We'll just give it a minute and then we'll get started. Just waiting for everyone to join the Zoom now. And while we're waiting, I'd just like to introduce Hayley, who's my colleague, and she's going to be on the line with us for this webinar. She'll be helping me to just manage the chat as we go, and feel free to say hi in the chat. Let us know where you're joining us from. As always, we love to know. And if you do have any specific questions throughout the webinar, we will have time for some Q&A at the end. But if you do have those specific questions, please pop those in the Q&A function, which you should be able to see at the bottom of your screen. So use that for specific questions, otherwise use the chat for any general commentary throughout the webinar or just to say hi as well, and Hayley will be there helping us out. I will share my screen and then we'll get into the content for today. Right, I think you should be able to hear me again. Sorry, everyone, I'm just having a bit of a microphone issue. Give me just a few moments and we'll get it sorted. All right, just checking you can still hear me. Everyone can hear me okay? Yep, all righty. I think we're good to get started. So today we're talking all about property. Just a reminder before we get started that Superhero does not provide financial advice. It considers your personal objectives, financial situation, or particular needs, and all investments carry risk, so please consider carefully before investing. Past performance is not indicative of future performance, and any pictures, graphics, charts, or graphs that are provided today are for illustrative purposes only. So a reminder that this webinar today is part of our Sector Spotlight series. And essentially what a sector is a group of stocks that have a lot in common with each other, usually because they're in similar industries. So when it comes to the market sectors, there are 11 of these, according to the most commonly used classification system, which is the Global Industry Classification Standard, or the GICS. And why do we categorize stocks? We categorize stocks into sectors to make it easy to compare companies that have similar business models. Sectors also make it easier to compare which stocks are making the most money. All right, so listed property. Now, when we think about property, most of us would automatically think of our own home or maybe an investment property that we have. So a little bit different to what listed property is or how it works. And there's kind of two main terms you might hear when it comes to listed property. So listed property is essentially an investment listed on the stock market that you can buy and sell that invests in or I guess does business in the property industry. And the main, I guess, type of listed property that you might encounter is a real estate investment trust, or commonly known as a REIT. And what a real estate investment trust is it's a company that owns, operates, or finances income producing properties. And throughout the webinar, we'll go through a little bit more around some different types of REITs in Australia, in the US as well, and how they actually make their income. Because there's lots of different ways and different types of properties they make their income from. Most REITs are publicly traded like stocks, which makes them highly liquid. So I guess the difference there between a traditional real estate investment is a REIT, you could buy and sell any market day on the stock exchange, whereas if you were investing in what's called real property, or you were making that property investment yourself, you would have to, I guess, outlay an investment for that, and it's not as easy to buy and sell. You've got to go through the offer, the settlement, often paying off a mortgage on that as well. So it's more of a long-term investment, whereas a REIT you could buy and sell quite easily, making it liquid. And REITs invest in most real estate property types, including apartment buildings, cell towers, data centres, hotels, medical facilities, offices, retail centres, and warehouses. So a range of different types of buildings that they might invest in, and we'll go through a range of different ones today. Now, the other thing to consider when it comes to investing in REITs is there's two main types of REITs. The first one is an equity REIT. So that's the more common type of REIT, and this is a REIT that invests in and owns properties and typically generates income through leasing out their properties and collecting rent. So an example of this might be a Westfields, for example, where a property company might own the Westfield or the building, and then they might lease out different spots or different shops within that. So that's an example of an equity REIT. So an example of that, like they've got there, hotels, shopping centres and apartments, versus a mortgage REIT, where a mortgage REIT is involved in the investment and ownership of property mortgages. So these types of REITs loan money to owners of real estate for mortgages and mortgage-backed securities, and they generate income through interest paid on the loan. So these are REITs that, loan out money for the purchase of property, as opposed to the other one, which is owning property and leasing that out. So two different types of ways that these companies make income. And who invests in REITs? So obviously, as a retail investor, you can go on to your superhero account and invest in a REIT. As an alternative, a lot of institutional investors like pension funds, endowments, foundations, insurance companies, bank trust departments invest in REITs. So there's a big retail element, but also quite a big institutional element of who invests in property, and in REITs specifically. And on the right is an example of the breakdown of assets in the Australian super high growth premixed option. So an example of a super fund. Now, super funds obviously kind of hold money in trust for their investors, and they invest that money according to whichever investment option you pick. So this on the right is an example of a high growth premixed option for Australian super. And you can see there, if we go down the list, there's two different types of property that they invest in. You've got unlisted property, so that's property that you aren't able to buy and sell on the stock exchange. And then they've got listed property there, which is what we're talking about when we talk about REITs, or real estate investment trusts. You can see they're making up 1.75% of the overall portfolio. Might seem like a small percentage, but with super funds, they're managing trillions of dollars. So, quite a significant amount of money that is invested by super funds into REITs. And just to note there that through Superhero Super, you can also invest in REITs. So you've got trading there, but also if you've got a Superhero Super account, there are a number of REITs that you can actually invest in to get exposure to that listed property in super. And how much of the ASX 200 does real estate make up? Real estate or property are interchangeable throughout this webinar. You might see it references both. Real estate making up 5.7% of the ASX 200. So that's companies like REITs or other property companies making up the ASX 200 there. You can see not as big as things like financial services or materials, but yeah, kind of sitting in the middle in terms of sector breakdown. And what are the companies that make up that breakdown? So the S&P or ASX 200 Real Estate Index contains companies in the ASX 200 that are classified as members of that real estate sector. So when we look on the right there, you can see Goodman Group being the biggest one, followed by Centre, Vicinity, Stockland, Mirvac. Some of these you might have seen before. You might see them on office buildings, or you might see them on shopping centres. Some of the other ones you might also not have heard of. And that's often because these are companies that kind of own a lot of property, but they may not be the ones actually operating the property in terms of you might have a shop that's actually leasing out from one of these companies and paying the company rent. So you might recognize the brands as opposed to the actual real estate companies that are the owners of that company. And just some trends. So when we look at the real estate sector, I'm sure many of us have heard a lot about what's happening in the property sector with inflation and how that affects interest rates. This is actually from one of the companies we're going to be speaking about today, from one of their reports, and it just looks at some of the, I guess, markers of the real estate sector that are used when thinking about the future and performance as well. So the first one there being the consumer sentiment index. So I guess how people are feeling about spending. You can see there that it really took a high in 2021 and throughout 2022, as we have seen inflation and interest rates rising, that has come down a bit. It's still not as low as it was during 2020, the beginning of 2020, but has come off from those 2021 highs. On the right at the top there, then we've got residential dwelling values. So again, a lot of these REITs invest in commercial properties, but they do also invest in residential properties as well. So you can see there that if we look at Sydney, for example, you've got all of the different kind of major capital cities there. This is an index as well of value. So you can see there that Brisbane looks the highest, but it's not in terms of real value. It's more of an index measure of performance. So you can see there that really kind of spiked at the beginning of mid of 2022, but that has started to taper off as well. And we know now we're, in November with interest rates rising, we have started to see that pullback in dwelling value as well. Just to cover off employment rate. So again, employment rate kind of hit an all-time low, but really, this is job advertisements that's being shown here, which I guess is the inverse of unemployment rate. So if we're seeing, or you can see the unemployment rate on the left. So unemployment rate did hit a bit of a high when we first had the lockdowns in 2020, but since then has kept dropping. And we're only just now seeing the job advertisements, start to taper off a little bit, meaning that, potentially the unemployment rate may start to tick up a little bit. As we know, a lot of companies have kind of hit harder times in the past couple of months. And on the right, the household savings ratio. So, when we had the COVID lockdowns, we did see all-time kind of high levels of household savings. You can see there June 2020, September 2020, and September 2021, kind of high household savings ratios. Again, as we've seen interest rates kind of starting to rise, those household savings have started to diminish as well. As we know, inflation's increased and therefore, cost of living is increasing too. So these are all kind of trends in the broader real estate sector that affect not only residential property, but do also flow through and affect things like commercial property as well. As dwelling values change, obviously that has an impact on the companies, not only their income, but also the value of the properties that they own as well. So important to have a look at the macroeconomic trends before we jump into the companies themselves and how they've performed. So getting into the companies themselves now, the first one we'll look at is Goodman Group. And Goodman Group is the largest company in the real estate sector by market cap on the ASX. So the Goodman Group, I'm not sure whether you've seen the green logo before, but essentially it's comprised of a couple of different entities, Goodman Limited, Goodman Industrial Trust, and Goodman Logistics. And it's the largest industrial property group listed on the ASX. So we'll go through a bit more about what that means in terms of their business in a moment. But when it comes to the fundamentals or their numbers, they've got a market cap of 31 billion. So pretty big. A dividend yield of 2.6% in the last 12 months and a PE ratio of 9.27%. So that's their profit to essentially their price to earnings ratio. So how does their share price perform compared to, or what's their share price compared to what they're actually earning, which is on the lower side, meaning that they are earning a lot of money compared to what their share price is at the moment. In the past year, their performance has not been great. It's been minus 28%. But in the last 5 years, overall, they've seen an increase of 98%. So if you kind of take that as a per annum base, it's a pretty strong return over the past 5 years, kind of around that 20% per year mark, which does outperform the overall market. Now, looking at who the customers of Goodman Group are, who, I guess the customers are those that lease out the buildings that Goodman Group owns most of the time, and whether that's office buildings, that might be warehouses as well. You can see there that their biggest customer is actually Amazon. So Amazon has 12.5% of their income, so really, really big, and they've obviously got kind of a long-term strong relationship there with Amazon. When we, I guess, are looking as investors, and this is not to say in the positive or negative, but you might see their relationship with Amazon as a really strong long-term sign when it comes to Goodman's future earnings. You might also see that as potentially a risk, because if Goodman all of a sudden lost Amazon as a customer, and you'd need to do your own research as to whether that was a significant risk, it could pose a risk to the business as well. So these are the things, and it's why it's really important to not only look at the overall income of the company, but also who are their customers, how do they make money, what are they investing in, to really understand and therefore decide whether it's a good investment for you. And you can see down there some other names you might know, the BMW Group, we've got Coles Group there, Global Express, Australia Post, so kind of some really, really big companies there that are customers of Goodman Group. And on the right, just to look at where the company has allocated its capital recently. So you can see the change there between June 2021 and June 2022 as well. They've really increased their property investments, they're developing in land, and they've got a couple of other investments as well. So really stepping up their investment into property over the last year. To move over to a slightly different type of, property investment, Goodman very much focused on office space, industrial space, warehouse space. Vicinity are more focused in the retail property sector. So they've got an integrated asset management platform and $26 billion in retail assets under management across 64 shopping centres. So big focus on the shopping centre industry with Vicinity. And it's the second largest listed manager of Australian retail property. Smaller than Goodman Group, so $8.7 billion market cap. Slightly higher dividend yield there, so 5.4% in the last year. And in terms of performance, in the last 1 year, Vicinity has actually seen an increase, but over the past 5 years, hasn't performed as well. So when you look at the chart there on the left, you can really see that after COVID happened, when we're thinking about shopping centres obviously, took a bit of a hit when it came to COVID and those shutting down. So you can see there saw quite a large drop off in the share price of Vicinity. And then it has slightly recovered, but it really has never recovered due to, to post or pre-COVID levels, that is. So, again, do your own research as to why that might be. But we know throughout COVID, the rise of e-commerce came through, and, that trend has continued, while not at the level it did when COVID initially happened. I guess Vicinity are directly affected by e-commerce, being that retail property company. But in the last year, interestingly, have seen an improvement in share price. And who are Vicinity's customers or tenants? So on the left there, you can see all of the big retailers and the percentage of income they make up of Vicinity's whole income. So Coles, Woolies, Kmart, the classics, David Jones, Myer, Target, Big W, JB Hi-Fi, Cotton On, and Hoyts. All companies that you'll see in pretty much every major shopping centre that you go to. And on the right there, just looking at firstly their net profit. So you can see there, and it's a little bit small, apologies for that, but they actually made a net profit in the last financial year when compared to the year before, which is a good sign. And you can see there also where they're actually getting their I guess, their gains from. So on the left, you can see their income from operations, or, essentially their income from tenants and things like that, which was 598.3 million. And then on the right there, you can see what's called their non-cash property valuation gains, or what was the difference in valuation in the property that they own over the last financial year. You can see there how much that makes up of kind of their total gains. So quite a significant impact there. Something in property that may not be the same as in some other sectors is that you've got obviously income if you're renting out property, but you've also got that capital gain, which would be, I guess, similar to a residential property investment if you have one of those. And on the bottom right, just interesting to look at some of the projects that they've got coming up. So Chadstone in Melbourne, I believe. We've got some in Sydney as well, Chatswood Chase, Bankstown. So they're still kind of developing new centres, and you can see there kind of the status of those and the estimated costs, which as an investor, can help you have a look at where the company's headed for the future and where they're investing. Alrighty, moving to a bit of a different kind of company. This one's actually not a REIT, so it's not a real estate investment trust, but it still operates in the property space, and that's PEXA. So PEXA listed not too long ago on the stock exchange, and it operates Australia's leading online property exchange network. So it assists members such as lawyers, conveyancers, and financial institutions lodge documents with the land registries and complete financial settlements electronically. So essentially, PEXA come in when you're purchasing a property, which I did last year, and PEXA is essentially the system, or the exchange network, where all of the different parties will come to on settlement day and execute that settlement. So they're doing that digitally, which in the past, I guess, would have been done manually, and they've really become the leading player in this space. So they've got a market cap of $2 billion, higher P ratio there, as I guess they're a newer company. They're still seeing quite a lot of growth as well. In terms of their performance, they have seen a bit of a drop off in the last year of 5.41%. And it says 5-year performance there, but that's actually, they haven't been listed for 5 years. So it's since listing, they have seen a drop of 15.63% in their share price. But you can see on the right there, it has been reasonably stable over the time that they've been listed on the stock exchange. So not huge drop-offs, and they've only been listed, I think you can see there, June 2021. So only been listed for about a year and a half now. So yeah, not too long of a history there that we can look at. And in terms of, essentially what PEXA do a little bit more, so they facilitate transactions. So you can see there, they've now facilitated 12 million property transactions through the PEXA exchange. Quite a lot there, settling over $2.4 trillion of funds on their platform. They've got nearly 10,000 firms that actually use their software, and over 160 financial institutions as well. When it comes to consumers, they've got over 1.1 million consumers that have actually settled through their platform. So a huge hold when it comes to the settlement kind of space in Australia. And yeah, you can see there that they integrate with different government systems as well, which obviously is very important when it comes to, their future in the property space. On the right there, you can see how they performed in the last year. Now, we know that the property sector in the last couple of years has been pretty crazy, and a lot of people have kind of gotten into the market as well. So, favourable industry conditions were recognised there, with 12% growth in total market volumes from FY21. And that refinancing volumes were also strong in the last financial year, up 31% year on year. So a lot of activity has been happening in the property buying and selling space, which obviously, as a settlement platform, PEXA has really benefited from as well. Now, moving over to the US. So we just covered off 3 Australian property companies. Now, moving over to the US, the first one here is the American Tower Corporation. Now, completely different type of property owner to the 3 we spoke about in Australia. These guys actually, they're still a REIT, so they're still a real estate investment trust, but they're actually the leading independent owner, operator, and developer of communications real estate, so essentially mobile cell towers. And they've got a portfolio of approximately 181,000 communication sites, which is just massive. And you can see there the market cap to match, so $94 billion market cap for them. You can see the information there. I won't go through it all. Their 1 year performance hasn't been so great either, but over the past 5 years, they've seen 43.49% growth, total for the 5 years. So you can do your per annum on that as well. And if you look there on the right, you can see how that's kind of gone up and down throughout the last 5 years. And essentially what's driving mobile communications? On the left, you can see how much data usage essentially is driven by the increasing use of apps, which obviously American Tower Corporation is a beneficiary of. You can see there how small the data usage for sending an email is, and moving up to even browsing the internet, and then compare that to how much we've got for watching 30 minutes of a TV show on the likes of Netflix and Hulu. Just an insane amount of mobile data in comparison that's being used there. So yeah, mobile data isn't going away. It's definitely grown massively in the past couple of years, and that's the business that AMT is in. So yeah, when we look at the right as well, this is the growth in devices and device usage, just growing year on year. So data usage is growing, and AMT are growing as part of that. More and more sites being developed there. And the last one we'll look at in terms of companies themselves is Public Storage. So another company listed in the US, and Public Storage is a REIT that primarily acquires self-storage facilities. So you might compare them to the likes of a Kennards in Australia, but they're a big one in the US. A market cap there of $34 billion. And they're not only in the US. So you can see there they've got on the left 2,500 self-storage facilities in the US, across, I believe it's 39 states. They've got a big interest in a company that owns a similar facility in Europe as well, so investment interest there. And they've also got a 42% interest in PS Business Parks, which owns a bunch of commercial space, so more similar to what Goodman does in terms of owning that commercial space and leasing that out. So huge company again, 34 billion. So similar to Goodman Group in size, but their main business is storage. And when we look at their performance over the past year, they've seen a decrease in 13%, but over 5 years, an increase of 38.3% in their share price. And what are they doing? So yeah, I've kind of gone over the information on the left already, operating in 39 states with 1.7 million customers. But on the right, you can see that while they are in 39 states, they have some key concentration areas. So one of those being Los Angeles. They've got, kind of a real hold on the self-storage market there. And you can see that they're really increasing the amount of self-storage units they've got in Los Angeles. And you can see they're accelerating on strong demand, limited new supply, and the expiration of pricing restrictions. So they're definitely taking advantage of that and building up, their hold on the Los Angeles market particularly. And it would be remiss of us not to mention an ETF. So an ETF here is the VanEck Australian Property ETF, or MVA is the ASX code. And we've gone through individual companies today, but look, if you're not sure exactly what company you'd like to invest in, an ETF may be something you want to consider. Again, not personal advice, do your own research, but what an ETF does is essentially gives you access or exposure to the performance of multiple companies in one investment, as opposed to investing in just one company. So MVA is an Australian-focused ETF listed on the ASX itself, so you can buy and sell it like a stock. And it gives investors exposure to a diversified portfolio of ASX-listed securities that track the index of the Australian property sector, essentially. So as part of that, you also get the dividend yield as a percentage of the performance of those companies. And just keep in mind there's a management fee for that as well, which isn't a fee that you have to specifically pay, but it's kind of taken out of the overall performance of the share or of the investment. When it comes to the performance of this particular ETF, in the past year, it has seen a decrease of 20%, and in the last 5 years as well, a slight decrease there. Again, this does not predict future earnings or future performance at all. And when you look at some of the market conditions that have happened in the past 2 years, particularly around COVID in the retail space and the commercial space, which a lot of these companies do have a large holding of that commercial, warehouse, office, retail space, all of which were affected by things like working from home and the closure of different retail centres as an effect of COVID. You can see there that they did take quite a dive during 2020 and haven't fully seen that recovery just yet in the market. And then we do have some kind of tough market conditions at the moment as well. So always important to look at the broader economics of what's happening, as well as the individual companies and what they're doing in terms of innovation. Because like we saw today, while the whole market hasn't performed great in the last, or it has seen a decrease in the last year, there are individual companies that are outliers to that as well. But obviously doesn't predict the future. It's really important to look at specifically what that company is doing. But if an ETF is something you're interested in, you can see on the right there the companies that this ETF holds. So things like Scentre Group, you've got Stockland in there, Mirvac, Goodman, Dexus, so all the big REITs and property companies in Australia. And on the right, you can actually see the percentage of the ETF that holding makes up. So Scentre, Stockland, Mirvac, all sitting at around 10% and kind of going down from there. So obviously the performance will be a reflection of not only what is in the ETF in terms of the holdings, but also the percentage that each holding makes up as well. That kind of overall will determine the performance and share price, and also the dividend yield that you get as an investor in the ETF. And that brings us to the end of our property-specific content. I'll just go through Superhero's features for those of you that might not be an investor with us already, and then I'll have a look and see if there are any questions. While I'm going through this, if you do have any specific questions, please feel free to pop them in the Q&A now, and we'll get to them in just a moment. So investing with Superhero, a reminder that you can invest in Aussie and US shares, which we went through today. We've got around 8,000 different investments on the platform, which might seem a little bit overwhelming, but we've got some pretty cool categorization and different kind of trending stocks you can look at on our platform as well if you want to have a look. And there's zero brokerage to buy Australian ETFs, $5 to sell, $5 brokerage on all other Australian shares, and zero brokerage to buy and sell US shares. You will have to pay a transfer fee when you go from Australian to US dollars if you do want to invest directly in the US market, but that all happens in real time, as well as deposits into AUD as well. And you can read for yourself there, but just a couple of other things we offer on the platform are live market data. We've got portfolio reporting as well, and you can earn Qantas points, which you can find more information about on our website as well, or contact our team on live chat from the website if you'd like to know more about any of the things listed on this slide. So let me stop sharing my screen, and I will get into a few questions. Alrighty. Okay, first question from Amir. What are some examples of equity REITs in the ASX? So Amir, some of the ones that we went through today are actually what we call equity REITs. So the likes of Goodman Group, of Vicinity, these are REITs that make money essentially through leases and through others paying them rent, and that's how they essentially earn income. So that's some examples. Again, you can go online and have a look as well, and you'll be able to find a list of all of the different REITs in Australia. And can we buy REITs in our Superhero Super account? Yeah, so Superhero Super has two different types of accounts. The first one is called Autopilot, and that's where most of your investment sits in our kind of diversified index option. So you won't actually be able to buy REITs in that account option. But if you've got the control account, you will be able to invest in REITs. So with that account, you've got to have 25% of your super sitting in the diversified index option. But with the other 75%, you can go in and invest that in a range of different shares and ETFs, which does include quite a few REITs. So you can go in and do that if you've got the Control Superhero Super account. And yes, what percentage of your super can you invest in one stock with super? So we've got actually a list on the website. It's on our support page, or you can contact us on live chat. The way Superhero Super works, if you have the Control account, you can invest in a range of different shares and ETFs that are all published on our website, and you can invest a certain percentage of your super into each share. So we don't allow you to go and put all 75% of your super into one stock. That wouldn't be very diversified of us, and it would kind of open you up to a lot of risk in terms of one company's performance. But yeah, we publish all of that information on our website in terms of the investments that are available and the percentage as well. So thank you so much to Hayley. She's actually just put that list in the chat. So if anyone's interested in what you can invest in with Superhero Super specifically, which is a slightly different investment menu to Superhero Trading, which you've got all of the investment options, you've got 8,000 there. So you can go in and have a look specifically for super in that link Hayley's put on the chat. All right, question, why is PEXA categorized as property? They don't own or lease property. Surely they are more of a fintech. I mean, the thing with these classification standards is that they, particularly in today where we've got a lot of companies that really cross over in sectors, yes, they could be easily classed as technology. They could be classed as financial services technically as well. But I guess why they've been classified as per the overall classification as a property company is because really their income is determined by the performance of the property or the real estate sector. So they're pretty much their entire business operates because property exists, and they very much, I guess, are things in the macroeconomics of the property sector will probably have the biggest impact on PEXA. So because pretty much all of their business is operating in property, they've been classified as property, even though they very much are a technology and potentially a fintech company as well. Alrighty, and a question particularly for PEXA as well. Why was their earnings per share so low last year when the property market was to the roof? Again, Amir, we've got to look at the macroeconomics, but also the microeconomics, or the company's, I guess, performance, their capital allocation itself. So you're right, the market was going crazy last year in terms of, property settlements and things like that. But there may have been another reason specific to the company about why that number came out, and potentially why the performance didn't match exactly what was happening in the broader market. So there are a range of factors that kind of impact each company. So what I'd recommend you to do is you could go on and you can actually look at all of the ASX companies, and you can actually do this in your Superhero app. If you go in and search a stock, so let's say PEXA, for example, you can actually see all of their announcements to the ASX. And one of those would include their FY22, which would have been to the end of June this year. You can see their report, which will explain kind of a range of different information around the company, where it invested its money, where its income came from. They'll often kind of make notes about the different factors that affected their income as well. So it's a really great way, those kind of annual reports, end of financial year reports, to go in and have a look at the company itself and its explanation for its performance as well. Alrighty, I think that's all of our questions for today. I hope that was really helpful for you all, and please let us know if you've got any further questions. You can come onto live chat and our team will be able to answer any further questions that you've got. And thank you so much for joining us today. It was a pleasure as always. I hope you get out and enjoy the rest of the day. It's a nice sunny day in Sydney, and we'll see you in a couple of weeks for our next Sector Spotlight. Thanks everyone.